as early indicators point to a strong recovery that will create a supercharged economy once the coronavirus crisis slows down. Moody's analytics chief economist Mark Zandi says that the biggest risk to that recovery isn't the runaway inflation that has many experts sounding alarm bells, but a dangerous surge in asset values. The S&P 500 index has soared almost 300% over the past 10 years, much in the way it did in the 10 years preceding the dot-com crash 2 decades ago. $2.4 trillion. That's how much forced savings, money that households would have otherwise spent but couldn't because of pandemic restrictions, analysts from Goldman Sachs estimate will be accumulated by the time the economy returns to normal in the middle of the year. Whether households spend a modest or large share of these pent-up savings as the economy fully reopens could be the difference between a healthy recovery and overheating, the analysts wrote in a Monday research note. Zandi isn't the only expert taking this view. In a January speech at Princeton University, Federal Reserve Chair Jerome Powell said he expects to see a strong wave of exuberant spending once the pandemic subsides that could push prices higher in the short term, but that he is not concerned about overheating and runaway inflation in the long term. Powell noted that there are still too many Americans seeking employment for wages to rise to unhealthy levels anytime soon, and emphasized that with interest rates still at rock bottom, the Fed has an arsenal of tools at its disposal to address rising inflation if it becomes problematic. Is the stock market about to crash? Forbes. Here's where $1,400 stimulus checks, $15 minimum wage and the rest of Biden's $1.9 trillion rescue plan stand today. Forbes. Here's what Biden's $2 trillion climate-focused infrastructure plan means for stocks and the economy. Forbes. Here's what could spark the next 10% market correction, Bank of America warns. Forbes.